Okay, let's unpack this. Imagine turning, say, $1,000 into, well, quite a bit more in just 5 years. Today, we're doing a deep dive into BROADCOM Inc. That's NASDAQ ticker ABGO. They're a tech giant that's seen some really remarkable growth, particularly with everything happening in artificial intelligence.
Yeah, it's fascinating. And Broadcom isn't, some startup just catching the AI waves. This company goes way back. Actually started in 1961.
Yeah.
It really shows how established players can pivot, can really evolve strategically.
Exactly. And our mission today is really to cut through the noise, pull out the key insights, the important numbers from the latest reports on Broadcom. We want to give you a clear sense of where they stand now and what their future might look like. We'll look at financials, the big drivers behind their growth, and some of the challenges they're facing too.
Right. And for you listening, think of it as understanding how a company with this long history adapts and frankly thrives when technology shifts so fast. We're mainly drawing on their financial filings, market analyses from experts, and Broadcom's own announcements.
Okay, so let's set the scene a bit. History. We said 1961, now headquartered in Palo Alto, but the name Broadcom, that actually came later, right? After Avago Technologies bought the original Broadcom core back in 2016. That
history of buying companies, especially under CEO Hockey Tan, that's really key to understanding them. And the huge one, of course, was VMware in 2023.
Yeah.
Was it $69 billion? I mean, that single move just completely shaped the company.
It really did. And look where they play now. Data centers, networking, broadband, wireless. It's worth remembering they're a massive supplier for Apple's iPhones. That gives you a sense of scale. Plus storage, industrial applications, and cybersecurity too, which is obviously huge now.
That diversification definitely helps make their business more robust. If you look at where the money comes from, semiconductor solutions is still the biggest chunk, about 60% of revenue, give or take.
And inside that semiconductor business, they're in some really hot areas. Custom AI chips, they call them XPUs. These are the specialized processors needed for all that AI number crunching. Then there's Ethernet networking, wireless stuff, optical interconnects, which are getting super important for moving data fast and storage. It's all about powering AI data centers, 5G rollouts, better broadband, that kind of thing.
Right. And then the other roughly 40% is infrastructure software. This is where VMware really makes its mark with virtualization and cloud software, but it also includes Symantec for cybersecurity and their mainframe software business.
Yeah.
The focus here is definitely on enterprise networking, storage, and hybrid cloud setups. So you've got the chips doing the heavy lifting for AI and the software providing the platform to run it all. It's quite a synergistic approach.
And their customer list, it's basically the giants. Cloud providers like AWS, Google, loads of enterprise IT departments, Apple, obviously, even industrial automation companies.
And what's really interesting is how their business model has shifted. They used to be mostly about selling chips, right? Hardware. Now, with VMware especially, they've got this big growing stream of recurring software subscription revenue. That often means higher margins and definitely more predictable income. Plus, it helps fund ongoing software R&D consistently.
That sounds like a smart move in a market that changes so quickly. But they're not alone, of course. Huge competitors out there. You've got NVIDIA, AMD, Intel, Qualcomm in the chip space, Cisco in networking, and then Palo Alto Networks, ServiceNow on the software side. It's a tough field.
Absolutely. That competition just puts constant pressure on them to innovate, to execute well across both chips and software.
So let's dive into the recent numbers. Fiscal year 2024 ended last November. The results look pretty compelling growth-wise. Revenue hit $51.57 billion. That's up, 44% from the year before? And they beat their own $50 billion forecast.
Yeah, the really eye-popping number in there was AI revenue. It surged 220%, hit $12.2 billion. And you see the VMware impact immediately, too, contributed $21.5 billion to that top line in its first partial year.
Okay, but on the flip side, GAAP net income, that actually dropped quite a bit, didn't it? Down about 58% to $5.9 billion. I assume that's the VMware effect?
Exactly. You buy a company that big, you're going to have significant acquisition and integration costs, amortization, that flows through the standard accounting.
Right.
But if you look at adjusted EBITDA, which kind of shows the underlying operational strength, that was up 37% to $28.83 billion. The margin was nearly 49%. So the core business is still throwing off a lot of profit, even with those integration costs.
And cash flow. That's usually a good sign.
Very strong. Free cash flow is $17.6 billion for the year. That's almost half their revenue. That gives them a ton of flexibility for dividends, buybacks, you name it. Gross margin held up too, over at 60%, helped by those high-value AI chips and software. And they ended the year with plenty of cash on hand, over $9 billion.
And dividends, they kept that going.
Oh, yeah. Raised it again for fiscal 25, up 11% to 79 cents quarterly. That makes it, 14 years in a row they've increased the dividend?
Yeah.
Pretty consistent message to shareholders.
Okay, so that was fiscal 24. What about the start of fiscal 25? Q1 ended in February.
The momentum seems to be holding. Revenue was $14.92 billion. That's up 25% year over year, and again, better than what analysts were expecting.
And the AI component, still strong?
Yep. AI revenue hit $4.1 billion in Q1, up 77%. Overall semiconductor revenue grew 11%, and infrastructure software was up a huge 47%, again, showing that VMware effect.
Well, profitability looked good, too.
Adjusted earnings per share was $1.60, beat estimates there, too.
Yeah.
And adjusted EBITDA, $10.08 billion. Up 41% with a really strong margin, 66%. That was even better than their own forecast.
Wow, 66% margin. Okay. And what are they projecting for the current quarter, Q2?
Guidance suggests they expect things to stay strong. Revenue around $14.9 billion again. AI revenue projected at $4.4 billion, still up 44% year over year. Semiconductor revenue around $8.4 billion, up 17%. And software at $6.5 billion, is up 23%.
So, okay, boiling it down. Key growth drivers seem pretty clear. Massive demand for AI chips from the big cloud guys. That's number one. VMware shifting to subscriptions, making software revenue more stable. And don't forget Apple, right? Their wireless business with Apple is expected to grow like 20% late last year.
Definitely. But it's not all smooth sailing. We mentioned the VMware integration costs hitting net income and, that dividend payout ratio over 170% based on GAAP earnings. That does raise eyebrows. Is that sustainable long term? It's a fair question.
Right. Okay, let's shift gears to the market's reaction. The stock price, AVGO. Performance has been, kind of incredible, hasn't it? As of mid-May 25, around $231, $232. Recent gains are huge. Nearly 5% in a day, almost 30% in a month, over 33% in 6 months. And for 2024 alone, up 99%. The S&P was up like 23% in that time. So massive outperformance.
And zoom out 5 years. The return, adjusting for the split they did, it's something like 775%. Yeah, 775%. That definitely gets investors' attention.
No kidding. And that pushed them into the $1 trillion market cap club, right, back in December 24. Happened after a big post-earnings jump. They're really playing in the big leagues now.
And analysts seem mostly bullish. The consensus among, 27 of them is a strong buy. Average price target suggests maybe another 22% upside over the next year. There's a range, sure, but generally positive sentiment.
How's it valued, though? That price-to-earnings ratio looks pretty high, over 80.
It is high, yeah. But that often comes with the territory for companies with huge AI growth expectations baked in. The market is pricing in a lot of future success. Dividend yield currently around 1%.
So what fueled those stock gains?
Well, a few things, probably. The 10-for-1 stock split back in July 24 certainly made the shares seem more accessible. Their dominance in custom AI chips, the XPUs, that's a big one. VMware's software growth, adding that recurring revenue stream. They also had a big $10 billion share buyback program. And maybe even slightly better vibes on U.S.-China trade recently helped investor confidence a bit.
Interesting to see the chatter online, too. You get the bulls pointing to the growth, the synergy between chips and software. But you also see some bears warning it's run up too fast, maybe due for a pullback. It's a mix, but leaning positive overall.
Let's look at some operational stuff that drives these numbers. They employ about 37,000 people now. Revenue split, as we said, roughly 60% semiconductors, 40% software.
Right.
And AI is a big slice of that semi-revenue, maybe around 30%.
And customers, serving over 2,000 enterprise clients. It's also interesting they tweaked the VMware sales strategy, leaning more on channel partners again to reach customers. And in that crucial custom AI chip space, they apparently control 70% of the market. And added 4 new hyperscaler clients this year. That's significant.
Yeah, it definitely points to continued strength there, which leads us nicely into their recent product innovations. These are key for future growth, right? The AI accelerators, those XPUs, they are really the star of the show right now. Custom chips built specifically for giants like AWS and Google for their AI data centers.
And the numbers back that up. $4.1 billion AI revenue in Q1, projecting $4.4 billion in Q2. Broadcom's talking about a $60 to $90 billion AI chip market by 2028. Some analysts think $60 billion a year by 2030. If they keep that market share, wow, what's their sustainable edge there, do you think?
Good question. Well, beyond just AI hardware, they're innovating elsewhere too. Cybersecurity, they launched this incident prediction feature for Symantec. Uses AI to spot those tricky living off the land attacks before they do damage. That helps their software segment grow, obviously. How does that compare to older security methods? It feels much more proactive.
Seems like it. And networking, they're improving that too. This Velocity platform integrates networking for AI infrastructure, trying to make data flow smoother in those data centers, and working with Corning on optical connections for AI clusters. Better bandwidth, less power. Why are optical links getting so important now?
Speed and efficiency, basically. As AI models get bigger, moving data around becomes a huge bottleneck. Optics help solve that. Plus, they rolled out the first end-to-end PCIe Gen 6 stuff. That's the latest standard for super fast connections inside servers, directly supporting those powerful AI XPUs.
Right. It all has to connect together seamlessly. And VMware keeps evolving too. The shift to subscriptions is key. Plus, new things like Bitnami Premium and their big VMware Explore conference coming up, all contributing to that software revenue growth.
So, summing up the product impact, AI XPUs are clearly driving the bus right now. Cybersecurity and networking wins help tie the software and hardware stories together. And VMware seems to be stabilizing and growing that software base. Although there was some churn, right, as they shifted the sales channel strategy.
Yeah, sounds like some short-term bumps there. And it's not all easy, is it? R&D for these advanced chips must cost a fortune. Plus, integrating VMware, that's hitting the standard net income pretty hard. Didn't one research firm even put a sell rating out, worried about AI market saturation down the line?
That's right. Seaport Research mentioned that. So stepping back for a critical look, strengths are obvious. Strong revenue growth, great adjusted profits, leadership in AI chips, and enterprise software, plus returning cash to shareholders via buybacks and dividends. That signals confidence.
But the risks are real, too. That net income drop from VMware costs is significant. The high dividend payout ratio needs watching. The high PE ratio suggests high expectations. Technical signals saying the stock might be overbought. And yeah, competition, especially from NVIDIA, is fierce. Plus the risk of maybe too many AI chips flooding the market eventually.
So market sentiment leans bullish, but with some valid technical worries. Looking forward, the AI growth potential seems huge, but success really hinges on executing the VMware integration, fighting off competitors, and managing that high valuation.
Okay, now for the part a lot of you might be curious about, the learners specifically wanted to know, what if you put $1,000 into Broadcom 5 years ago? Let's do the reveal.
All right, let's break it down. If you invested $1,000 back in May 2020, the stock price then, adjusted for that later split, was around $27.56 a share.
Okay, so $1,000 gets you just over 36 shares. 36.29 shares, roughly. Fast forward to today, mid-May 2025, stock's around $231.58. Those shares are now worth, wow, $8,403.65.
That's a return, just on price appreciation, of over 740% in 5 years. Works out to about 52.2% per year compounded.
That's a big bet.
Yeah, that's remarkable for an established player.
But wait, there's more. Dividends. They paid dividends all along and increased them. Holding those 36 as shares, you would have collected roughly $327.76 in dividends over those 5 years. The annual payouts, split adjusted, went from like $N and $31 at 36 cents per share.
So add those dividends back in, your total value from that initial $1,000 investment jumps to $8,731.35.
Which means the total return, including dividends, is a stunning 773.14%. That's an annualized return of nearly 54%, almost 54% a year. And just for context, the S&P 500 total return over that same time, about 80%. So Broadcom just blew it away.
So yeah, wrapping up our deep dive for you. Broadcom's story is one of significant growth, fueled by smart acquisitions like VMware and riding that massive AI semiconductor wave. Plus, they built a solid growing software business alongside it. And as that $1,000 example shows, it's generated huge returns for investors recently.
Definitely. But like we've said, it's complex. The past returns are amazing, sure, but the high valuation now, the ongoing VMware integration costs, the tough competition, those are all things to weigh carefully looking ahead.
Which brings us to a final thought for you, our listener. Given Broadcom's really bold and mostly successful moves into AI and software, what other big established tech companies might be making similar kinds of transformative bets right now? What signs, what strategic moves would you look for to spot the next potential high-growth story like this?
Something to think about. If you want to dig deeper yourself, check out Broadcom's investor relations site, investors.broadcom.com. And their next earnings call for Q2 2025 is scheduled for June 5th, 2025. That should give more updates.